in conversation with Sunil Singhania, CIO at Reliance Mutual Fund. Sunil, thank you so much for taking out time for us. You've been a big bull about the Indian markets, how we are going. I had earlier seen your presentation, one presentation where you had said that, we are a 2 trillion economy and, we can see substantial growth coming in very fast. Can you just take us through that and how will that lead to markets and earnings growth?
So, if you see, we got our independence in 1947. By the time it was 2007, we reached $1 trillion. The next $1 trillion was achieved in 7 years. So we are now a $2 trillion economy. There are only 9 countries in the world with a $2 trillion economy. Our view is that we would be a $4 trillion economy in the next 7-8 years. That would make us maybe 1 out of the 4 or 5 countries at that point of time with this kind of a market, economy size. And even if you take 1:1 GDP to market cap, so from a market cap of $1.5 trillion, we can potentially go to $4 trillion as far as the market cap is concerned. So there's this huge $2.5 trillion of wealth which is likely to be created over the next 7-8 years. So I think if you believe in this, then you will definitely have great returns in Indian equity markets.
Till now for the last 4-5 years, Sensex EPS, which you look at very closely, has not been growing that great. So we've started by 18-20% growth and then trimmed it down. Do you think now the base effect is in our favor and now the growth would essentially come in?
So it's not the first time this has happened. We have seen this kind of a scenario from 1999 to 2003, where except IT, nothing was growing, in fact degrowing. And what is happening now is similar to the period from 2003 to 2008. So companies have capacities, demand has not been there. Hopefully with GST, with monsoon, with a lot of liquidity flows, with a push from government towards capex, this demand should start to rise. So we'll have this huge operating leverage. And if you combine it with the fact that we have already had 150 basis points rate cut and still at 7.2%, India is maybe one of the most expensive as far as interest is concerned in the world. You have more scope for interest rates cut. So we'll have an operating and a financial leverage, coupled together. So we are quite optimistic that yes, last 3-4 years earnings have disappointed, but there is a possibility of their surprise coming very soon.
Right. You handle big money, you handle large amount of chunks. Ps are just getting re-rated. But it's a very different environment where we have, so German bonds are trading at negative price, a lot of money is trading at negative yields. In that scenario, looking in at global PEs, would not be sense, or PEs can just re-rate because of money being very cheap?
So what is PE? PE is the reverse of earnings yield, and earnings yield are basically have to be looked in comparison with the fixed income bond yields. So if you look at the 10-year average PE multiple, we were at 15.5 as far as India is concerned. Right now we are maybe 10% higher on a 1-year forward basis. But the weighted average cost of capital, which is a combination of your cost of debt and cost of equity, has gone down significantly. And that's a combination of interest rates falling and maybe more to go, as well as the risk premium of the country having fallen significantly. So everyone, including global investors, realize that Indian currency has been much more stable than it has ever been. The risk premium which the foreign investors were giving to investing in India was maybe 5, 6, 7%. It has at least come down by 100-200 basis points, and maybe it might come down more. So a weighted average cost of capital has the potential of falling, and that would mean that maybe this high P multiples are there for good.
Right. So as a CIO, as a big fund manager, do you get scared with these sort of multiples to invest fresh money, or it's broadly a call that you're taking for a 5-year view where earnings would come and these PEs would not matter?
So large investors have said that you can't be greedy and fearful. So there is no question of being scared. At the same time, you have to be cautious and not get carried away. There are some sectors, there are some stocks where there is definitely euphoria. And there is so-called selling fear. People are fearful of selling because every day they keep on rising. So I think our job as experienced and maybe matured investors is to keep an eye on what is sort of euphoric and where there is still money to be made.
Right. Just a word on India consumption. Some of these consumption stocks, durable stocks have done very well. They have delivered very good returns to their investors, but earnings have not picked up. Do you believe with monsoon, with GST coming in, 7th pay commission, people are getting better jobs, pays are rising? Do you think that all of this is still we are yet to see the best of consumption?
So I think we have to see ourselves. If we believe that we are not going to consume more as we go forward, then please don't buy these stocks. If you believe that as human beings, there is always a desire to consume more and better, and that is also going to happen in India as it has happened all over the world, then there is no doubt in our minds that this demand is ultimately going to come.
You always talk about niche sector. Just a last word, any 2-3 niche sectors or sectors within sectors where you're seeing things changing?
As I said, niche financials, move from physical savings to financial savings. So life insurance companies, mutual fund companies, wealth management companies, they will be big beneficiaries. We are moving towards wearing good, buying good, staying good. So I think everywhere where there's some kind of a seasoned brand, that should do well. I think niche capital goods sector where there is clean balance sheet will benefit big time because there's a latent appetite from companies to grow. And with equity and debt now being available much more than it was earlier at a better rate, I think companies will go in for capital expenditure. So niche capital good companies will also again be.
Sunil, thank you so much. Always a pleasure.
Thank you.